It's been a week of messages from two of the world's leading central banks. Let's start with the Bank of England. Alan Clark of Scotiabank. What did we learn from the minutes of their latest meeting?
Well, they produced minutes which came against the backdrop of updated projections for the economy, and they've dramatically brought forward the point at which they get to this magic 7% unemployment rate. Previously they said it'd be the end of 2016, now they say middle of 2015 or end of 2014, depending which of their forecasts you look at. That's slashed in half the time over which they've committed to not raise interest rates. I think actually they'll bring it forward even further in the next 3 months because they're a little bit behind the times. So the market could get excited that rate hikes will come sooner rather than later, but in the bigger scheme of things, and that's what we were looking for in the language of these minutes, there's no way they can start to hike interest rates anytime soon, particularly when the other central banks around the world are loosening policy still.
Did they give any indication what they'd look at when unemployment got to 7% and how much longer they might wait before raising rates?
For me, wage inflation is at the heart of the debate for them because household spare cash is going down, not up. And unless wage inflation picks up, we can't withstand interest rate hikes because that would just make the situation go from bad to worse. So that's key. Productivity is their buzzword, but essentially that's an early warning sign of whether or not medium-term inflation pressures will pick up or not.
Brian Hilliard of SG, what do you think is the likely path of interest rates based on these messages from the Bank of England?
Well, I think that they're going to raise rates in the back half of 2015. And paradoxically, because their forecasts now show the unemployment rate hitting 7% so early, it's going to crystallise our views because nobody realistically can expect them to plan to raise rates at that time. So we have to prepare for new signals, new messages from them to make it clear to us that they're not going to raise rates in 2014.
Do you think forward guidance, the policy as it's known, is now been a bit blurred?
It's more than a bit blurred. I think they've got to change the lens completely because they are making it very difficult to understand what they mean. And my way of interpreting it is to use the unemployment rate purely as a device to tell us what they want to do on rates. And what they want to do on rates is keep them unchanged for a long time.
Alan, we also got minutes from the US Federal Reserve. What do we learn about their plans for so-called tapering, easing back on creation of new money?
Well, they're still buying billions of assets each month, and market speculation has swung back and forth as to when that's going to start. And most forecasters now think that's been pushed back into the new year, maybe January, but I think most people are centred on March. Now, the language in this week's minutes teased the market to think, well, any time's possible. They said in the coming months. So they didn't rule anything in, but they didn't rule anything out either. And you wonder whether that's deliberate, because we're going to have another round of political shenanigans on the public finances in the early new year, and there's likely to be a soft patch in the economic data and a new central bank governor. So it's an outside chance you could get tapering in December, but really it'd be brave to bet on that. I think most people would assume they will take their foot off the accelerator pedal in the new year, which is worlds apart from us thinking about possibly putting the foot on the brake.
So, Brian, what does it mean for world markets and the UK when the US central bank starts easing back on the accelerator?
I think for the world markets, they're quite expecting it, so I think the reaction will be quite muted. Emerging markets have already had their big reaction when we had the first suspicion of tapering, then they've sort of recovered a little bit. So they're going to be quite muted when that happens. For the UK, I think very little reaction, to be honest. It's going to be a very gradual change in policy by the Fed. For the UK, the debate is keeping rates on hold still.
So, Alan, what does this all add up to in terms of how the world economy is performing and what it means for UK households and businesses?
We're in a better place now. The fact that we can contemplate the first interest rate hike, albeit not for a long while, and less policy easing elsewhere, it's good. It's better than we were 6 to 9 months ago. But there are some dark clouds still. The dreaded D word, deflation, has come back. We worried about it a few years ago. It didn't happen because things got in the way of it, like tax hikes, energy bill spikes, food price inflation. But now, given that we are punching beneath our weight still, there is a chance that we slip lower down. I'd say it's good deflation because if you see energy bills going down and food price inflation down, that's less of a squeeze on people's pockets. But central banks nonetheless are charged with keeping inflation at a decent level, and they will worry. So things are great, not perfect, but we're moving in the right direction.
Alan, Brian, thanks very much.